Dedrick.
Okay. So again, I'm Dedrick Asante Muhammad, Director of Economic Department for the NAACP. Just making sure they have my slide up there. I was told not to be long and boring, so I will try to speed through this and at least not make it long. You'll have to judge how boring it is. So let's go to the next slide and just want to highlight briefly NAACP Economic Department. Actually, first I want to say, to me, these Color of Wealth Summits have been foundational for me. I've been attending various incarnations of this, and this has really been the foundation of what I understand around race and the economy. And we have our NAACP Economic Department. If you could raise your hand, most of them in the back, in the back. And I really want to make sure that they were all here to get this type of information, because there aren't many opportunities throughout the country to get this type of analysis on how race inequality and economic inequality intersect. And out of that, the NAACP Economic Department has four main areas we're trying to focus on: economic education, fair lending, diversity and inclusion, and community economic development. Let's go to the next slide. And I think I'm going to repeat a little bit of what was said by Mr. Silver. I mean, oftentimes, actually, I was reading an article, and it was talking about how the radicalness of the civil rights call for economic empowerment, particularly as it relates to housing, was greatly set back when the demand for housing started becoming a demand for greater access to credit. And I think there is a confusion. We oftentimes talk about, well, is there enough access to financial products? What financial products are out there? But the primary challenge is growing economic inequality, right? It's people not having enough income. The problem is not that they don't have the right credit card, or they don't have the right type of loan. As Mr. Silver put forward, they don't have enough money to meet their bills. And oftentimes, too often, what is being put forward to them is, well, try this other type of loan, and this will solve your problem. So, and again, this is the solution, but we cannot separate dealing with financial products from living wages, unemployment, these types of issues, wealth inequality. I won't go point by point down there. I think most of these type of points have been discussed throughout the day. So let me go to the next slide, which is just a chart, again, of what Mr. Silver was highlighting, looking at how the gross domestic product, which is the blue line, has been greatly growing over the last near 20 years, while we see the red line being median income has been stagnant. And again, anytime we talk about financial services, we need to recognize that reality. Again, not blaming the victim for not knowing what financial products to use, but understanding that they don't have enough income to deal with their current problems. Let's jump to the next slide. We do a lot of work with major banking institutions at the NAACP, and I think one thing that is true is that many financial institutions don't see enough profit. Not that there isn't profit, but enough profit to focus in on financial tools for low to moderate income people. And I always bring that forward when some bank is saying, well, we serve 25% of our population's low to moderate income. Well, yeah, but that's 80% of the African American Latino community are low to moderate income. That's the majority of Americans. And so if your demands for profit return says, well, I can only make this little kind of charitable group we're going to do little projects with here and there, and that's the majority of America, then we're running into this challenge that the major financial institutions in this country are no longer focused on and you can argue how much they ever were, to dealing with the financial needs and resources for the average American. Let's go to the next slide, and I want to highlight an article that was sent to me today. It said, LendUp, which is a lending company, LendUp raises $50 million to disrupt payday lending. And it has this article about, how they're here to help solve the problems of low to moderate income, and through financial education, they'll be able to do that. And how they're an innovative lending company. And I've met the head of LendUp, and he seems like a nice person, but this is so misleading, and it's kind of, I think we're getting into the payday lending 2.0, right? Because if you look at LendUp's website, you look at their APR. It doesn't say it in this article, but you look at their website, their APR is 200% to 400%. So LendUp raises $50 million to disrupt payday lending. And I don't know how to say this other than it reminds me of when I was living in Harlem, and the Bloods first came to kind of Harlem. And the headline wasn't "Bloods disrupt gangs," in Harlem. It was an increase in gang activity. This isn't disrupting. This is disrupting in that it's increasing payday lending. $50 million is being raised to increase payday lending, and they're not even calling it as such. And again, I think the challenge of, and it's clear, the big picture is Americans have less and less money to pay more and more bills with less and less resources from mainstream financial institutions. So now there's all of this interest in how smaller institutions can make money off of people trying to keep their head above water. And I'll just highlight one other line from this, and then I'll stop talking. It talks about lend up, and it says, as we've written in the past, the startup is trying to solve the problems at the cause, which is poor financial education. And I think for all these things, it's best just to understand the basics, right? Again, the problem of poor people isn't poor financial education, it's they're poor, right? So I've never seen a neighborhood where just financial educators came into the neighborhood and then the neighborhood's thriving, right? I've seen jobs come into a neighborhood, right? And then the local economy gets better, but we do financial education. Financial education is important, but financial education of poor people, it does not make them wealthy. It is not poor people's fault. It's not African Americans' fault of the racial economic inequality and where the situation is not Latinos' fault. And I think I didn't get to solutions. Let's skip a slide. Let's go to the next slide. See, I know I'm out of time. I think generally I'll just say that, I think Consumer Financial Protection Bureau is an important step in the right direction. I think we do need a new regulatory environment which focuses on strengthening the American middle-class economy rather than institutions which finance the wealthiest Americans. We have to be clear what the goal is. If it's just to make banking safe again, and banks haven't been banking many of us, that's not helping dealing with that crisis. And then the last slide, I would just say, again, I think a lot of great work can be done at the state and local level, whether it's through different types of coalitions that I've seen come out of these Color of Wealth Summit meetings. And I think, again, we have to recognize that if we don't deal that the greatest threat to the American economy is the weakening middle class and the growing racial economic inequality. That's the greatest threat. It's not that poor people and middle-class people don't know how to spend their money or are too dumb and keep using payday loans. So I'll end with that, and I'm sure you'll get some more detailed information from the next of the panelists.
Thank you, Dedrick.